Hi, greetings, it's me, Dr. Paul Gerhardt, and this video has to do with managerial control. And so what I'm going to be talking about today are ways that companies develop control systems for employees, summarize how to design a basic bureaucratic control system, describe the purpose for using budgets as a control device, recognize basic types of financial statements, financial ratios used as controls, listing some procedures for implementing effective control systems, and discussing ways in which market and clan control influence performance. So let's get right into this video. What is control? Great question. So control is any process that directs activities of individuals toward the achievement of organizational goals. And so obviously every organization is in business to accomplish some sort of organizational goals, and it's up to leaders to really make sure that they're aligning people properly to make sure that customers ultimately are being taken care of, they leave completely satisfied, and they have no reason to look at the competition. So, and that also, of course, means making sure that the quality of the products or services is seen as competitive and of course, desirable. So that brings up the question, what are some signs in which companies lack controls? And so I've worked with many different types of organizations. I've seen a lot of different problems from a leadership perspective that has caused problems throughout the whole organization. And so here's a list of some of the top things that I've seen. Lax management, senior managers not emphasizing the value and need for controls and setting bad examples. Absence of policies. This is about the firm not having expectations in writing. A lack of agreed upon standards. Organizational members are unclear about what needs to be achieved. Shooting the messenger. The employees feel that their careers would be at risk if they reported bad news. Lack of periodic reviews. Managers do not assess performance on a regular basis, or if they do, they don't do it accurately. Bad information systems. This is about key data and not being measured or reported in a timely and easily accessible way. And then lack of ethics within the culture. This is where organizational members have not really internalized commitment to integrity. So there are all sorts of problems that can happen in an organization when leaders aren't leading by example and really having clear expectations. One of the biggest problems, we talk about what happens when you assume. And when people are assuming that people understand, but we're not clarifying expectations, things can start to break down, and then one problem leads to another problem. So we've done a lot of studying about what management really needs to be doing, and so today we're really talking about managerial control. And essentially I want to talk about bureaucratic control, which is the use of rules, regulations, and authority to guide performance. Marketing control, which is about control based on the use of pricing mechanisms, economic information to regulate activities within controls. And something called clan control, and this is control based on the norms, values, and shared goals and trust among members. And so let's talk about the control process. Essentially, the control process has systems with four main steps to it. 1, setting performance standards. 2, measuring performance. 3, comparing performance against standards and determining deviations. And then 4, taking action to correct problems to reinforce success. It's really easy to show up and go to work and just assume everything's okay, but what gets measured can be improved. And so it really is important to really understand that you got to set clear performance standards, that you got to make sure that those that there are clear measurements for that, and then you got to measure it. and then you got to compare performance against the standards and determine any kind of deviations, and then take action to correct problems. And so in the most successful organizations, they're constantly doing things to help employees become even better at what they do, and organizations need to stay competitive. And so that's a really big thing for us to be thinking about, is what worked for us yesterday probably isn't going to all work today, because organizations' competitors are constantly changing, and the needs of the stakeholders or customers are constantly changing. So this is why control is so important, and things constantly need to be moving forward. Let's talk about some of the common measures for standards. And standards really are the expected performance for a given goal, a target that establishes a desired performance level, motivation, performance, and it can serve as a benchmark against the actual performance that's being assessed. So those include quantity, quality, time used, cost. Essentially, we need to make sure that for production activities, including volume and output, that's the quantity, defects, which is the quality, on-time availability of finished goods, that's time, and then dollar expenditures, raw materials, direct labor costs, many important factors that affect performance, and that includes customer service. You need to be able to measure things, have very clear expectations. You got to have adequate supply and availability of the products, services, and the quality of the service, speed of the delivery, and that kind of stuff. All those things matter. They matter to your customers, they need to matter to each employee, and they certainly need to matter to the leaders that are involved. So leaders can't be lazy. Leaders need to have very clear expectations, empower people to make good decisions, and then make sure that they're constantly checking to make sure that those expectations are being met. So you have to make sure that you're always comparing performance with the standard. And so there's something called the principle of exception. And that's a management principle stating that control is enhanced by concentrating on the exceptions to or significant deviations from the expected result of the standard. So with the principle exception, only exceptional cases require corrective action. The principle is important in controlling. The manager is not concerned with performance that equals or closely approximates the expected results, and managers can save time and effort if they apply the principle of exceptions. So bureaucratic control occurs before, during, and after operations, and we use three basic terms for this: feed-forward control, concurrent control, and then feedback control. So feed-forward control takes place before operations begin and includes policies, procedures, and rules designed to ensure that the planned activities are carried out properly. Examples include inspection of raw materials, proper selection, and then training of employees. Concurrent control takes place while plans are being carried out. It includes directing, monitoring, and then fine-tuning activities as they occur. And then feedback control focuses on the use of information about results to correct deviations from the acceptable standard as they arise. Let's talk about a very common model called Six Sigma. And one of the most important controls ever to come out is Six Sigma. It's particularly powerful because it helps give feedback control. Six Sigma is designed to reduce defects in all the organization's processes, not just product defects, but anything that may result in customer dissatisfaction, such as inadequate service, delayed delivery, and excessive high prices due to high cost or inefficiency. The system was developed by Motorola in the late 1980s when the company was found that it was being beaten consistently in a competitive marketplace by foreign firms that were able to produce higher quality products at lower costs. So Six Sigma is is about producing fewer than 3.4 defects per million, which means that it has it's operating at a 99.9996% level of accuracy. So Six Sigma companies have not only close to zero production or service defects, but also substantially lower production costs and cycling times and much higher levels of customer satisfaction. So it's a really important model. Some hypothetical examples of Six Sigma. Let's go there. So 3,443 correct debit card transactions per week, for instance, or 2,700 airline flights per month with a problem, or 4,760 defective smartphones produced each year. So whatever your organization does per million, that's what that really would equal as it relates to, your outputs. So it's about really having clear measures to help you be able to look at what's happening, and can you create or fix systems to make things be more efficient and effective. So there are management audit control systems, and management audit is an evaluation of the effectiveness and efficiency of various systems within the organization. So managers conduct external audits of other companies and internal audits of their own company, and some of the same tools and approaches are used for both approaches. So it becomes a kind of an accounting process where efficiencies and effectiveness is being managed. So internal and external audits, let's talk about that. And an external audit occurs when one organization evaluates another organization. Typically, an external body such as a CPA or Certified Public Accountant firm conducts financial audits of the organization, and then a company conducts external audits of competitors or other companies for its own strategic decision-making processes. This analysis investigates other organizations for possible mergers or acquisitions, determines the soundness of a company that will be used as a major supplier, or discovers strengths and weaknesses of a competitor to maintain or better exploit the competitive advantage of the investigating organization. Publicly available data is used for these evaluations. External audits provide essential feedback control when they identify legal or ethical lapses that can harm the organization and its reputation. They are also useful for preliminary control because they can prevent problems from occurring. If a company seeks to acquire other businesses, gathers adequate, accurate information about possible candidates, it's more likely to acquire the most appropriate companies and avoid unsound acquisitions. It's good to know that organizations may assign a group to conduct an internal audit to assess the company, and it's better to understand what it's done for its customers as it relates to people who are purchasing their goods and services. The company can be evaluated on a number of factors, including financial stability, production efficiency, sales effectiveness, human resource department, earnings growth, energy use, public regulation, service responsibility, and other criteria for organizational effectiveness. So the audit reviews of a company's past, present, and future, including any risk of the organization, can be assessed. So budgetary control is something else we should talk about, and it's one of the most widely recognized and common used methods for control. It ties together feed forward, concurrent, and feedback control depending on the point of which of which it's applied. Budgetary control is the process of finding out what's being done and comparing results with corresponding budget data to verify accomplishments or remedy differences. Budgetary control commonly is called budgeting. So there are a number of many types of budgets, and these are the ones that are frequently used. A sales budget, for instance, and this usually data for sales budget includes forecasts by sales by month, sales area or product, production budget. This is the production budget, which is commonly expressed in physical units. Required information for preparing this budget includes types and capacities of machines, economic quantities to produce, and availability of materials. Cost budget. The cost budget is used for areas of the organization that incur expenses but no revenue, such as human resources and other supporting departments. Cost budgets may also include production budget, and costs can be fixed, independent of immediate level of activity like rent, or variables like rising or falling levels of activity like raw materials. Cash budget is something else. The cash budget is essential to every business, and it should be prepared after all budget estimates are completed. The cash budget shows the anticipated receipts and expenditures, the amount of working capital available, next to which outside financing may be required, and periods and amounts of the cash that's available. Capital budget. The capital budget is used for the cost of fixed assets like plants and equipment, such as costs are usually treated not as regular expenses, but investments because of their long-term nature and importance to the organization's productivity. Master budget. The master budget includes all of the major activities of the business. It brings together and coordinates all the activities of the other budgets and can be thought of as the budget of budgets. So traditionally, budgets were imposed from the top down, with senior management setting specific targets for the entire organization at the beginning of the budget process. In today's more complex organizations, the budget process is more likely from the bottom up, and with top management setting the general direction, while lower levels and middle level managers actually develop the budgets and submit them for a proposal. So two different types of budgets, accounting audits and actively based costing, which is ABC. Accounting records really must be inspected periodically to ensure that they're properly prepared and correct. Accounting audits, which are designed to verify accounting reports and statements, are essential to the control process. This audit is performed by members of an outside firm of public accountants. Knowing that accounting records are accurate, true, and keeping with generally accepted accounting practices, which we call GAAP, it creates confidence that a reliable exists for sound overall controlling purposes. Traditional methods of cost accounting may be inappropriate in today's business environment because they're based on outdated methods of rigid hierarchical organizations. Instead of assuming that organizations are bureaucratic machines that can be separated into component functions such as human resources, purchasing, and maintenance, ABC starts with the assumption that organizations are collections of people performing many different but related activities to satisfy customer needs. The ABC system is designed to identify those streams of activity and then allocate costs across particular business processes. Let's talk about the balance sheet. So the balance sheet shows the financial picture of a company at any given time. This statement itemizes three elements: assets, and these are the values of the various items the company owns. Liabilities, these are the amounts the corporation owes to other various creditors. And then stockholders' equity, and this is the amount accruing to the corporation's owners. So the relationship among these elements is assets equals liabilities plus stockholders' equity. And so you can use that math equation to help understand the health of your organization at any time. A profit and loss statement is also important to understand, and it is an itemized financial statement of the income and expenses of a company's expectations. So talk about some various financial ratios. And so something called the current ratio is the liquidity ratio that indicates the extent to which short-term assets can decline and still be adequate to pay short-term liabilities. Debt equity ratio, and this a leverage ratio that indicates the company's ability to meet its long-term financial obligations. And then return on investments, or ROI. And that's a ratio of profit to capital used as a rate of return for capital. Something that you need to understand too is something called management myopia. And although ratios provide performance standards and indicators of what has occurred, exclusive reliance on financial ratios can have a negative consequence. So ratios usually are expressed in limited time horizons, monthly, quarterly, yearly, so they cause management myopia. Managers focus on short-term earnings and profits at the expense of the longer-term strategic obligations. So to reduce management myopia and focus attention further into the future, control systems can use long-term, say 3 to 6 year targets. So always have to think about bureaucratic control. It's a hard word for me. It has downsides. So rigid bureaucratic behavior, tactical behavior, and resistance control. We have to keep in mind that organizations are made out of people. And so rigid bureaucratic behavior occurs when control systems prompt employees to stay out of trouble by following the rules. Unfortunately, these types of systems often lead to poor customer service and make the entire organization slow to act. Some managers will not even use the term bureaucratic control because of its potentially negative connotation. However, the control system itself, that really is not the problem. The problem occurs when the systems are no longer viewed as tools for running the business, but instead as rules for dictating rigid behavior. Tactical behavior controls will be ineffective if employees engage in tactics aimed at beating the system. The most common type of tactical behavior is to manipulate information or report false performance data. Often people strongly resist controls. They do so for a few different reasons. Comprehensive control systems increase accuracy, performance, and make employees more accountable for their actions. Control systems uncover mistakes, threaten people's job security and status, and decrease people's autonomy. Control systems can change expertise and power structures. Control systems can change an organization's social structure, and they can create competition and disrupt social groups and friends. Many people end up competing against those with whom they formerly were comfortable and cooperating with. And people's social needs are important, so they'll resist control systems that reduce satisfaction to those needs. Control systems may be seen as an invasion of privacy that leads to lawsuits and causes of low morale. So happy employees are generally more effective employees, right? So you have to have more effective control systems. And effective control systems truly maximize potential benefits and minimize dysfunctional behaviors. To achieve this, management needs to design control systems that meet several criteria. 1, they're based on valid performance standards. 2, they communicate adequate information to employees. 3, they're acceptable to employees. 4, they use multiple approaches. And 5, they recognize the relationship between empowerment and control. So a balanced scorecard is really important to have. And so that because we know that there are multiple controls that are necessary, for example, banks need controls on risk so that they don't lose a lot of money from defaulting borrowers, as well as profit controls, including sales budgets that aim for growth in accounts and customers. As we talked about earlier, control systems generally should include both financial and non-financial performance targets and incorporate aspects of preliminary, concurrent, and feedback control. In recent years, a growing number of companies have combined targets for managers into what's called a balanced scorecard, which is a combination of 4 sets of performance measures: financial, customer satisfaction, business processes related to quality and efficiency, and then learning growth. The goal is generally to broaden management's horizons beyond short-term financial results so the company's long-term success is more likely. So, the concept of empowerment really is important to understand. Not only has this become more popular in organizations, but it's also become a necessary aspect of a manager's repertoire of control. With no one best way to approach a job and no one way to scrutinize what employees do every day, managers must empower employees to make decisions and trust that they will act in the firm's best interests. This doesn't mean giving up control. It means creating a strong culture of high standards and integrity so that employees will exercise effective control on their own. So, in a nutshell, we've talked about why control systems are necessary. We talked about the design of bureaucratic control systems. We talked about the purpose of a budget. We talked about financial statements and ratios and how to implement control systems, and then about market and clan controls. So anyway, I hope that you've enjoyed this video on managerial control and you take something away of it that you can use. And even more importantly, I hope that you have a great day, because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.